Welcome back to the Deep Dive. If you're enjoying these deep dives, be sure to hit that like button and subscribe to our channel for more deep dives just like this one. Today we're going to be taking a deep dive into a day of market mayhem, where global events had investors on the edge of their seats. From presidential showdowns to some twists and turns in economic data, it was a real roller coaster. So let's imagine the tension in the Oval Office as President Trump and Ukrainian President Volodymyr Zelensky clash on camera over a potential ceasefire in the Russia-Ukraine war. Now, the market reacted immediately with stocks taking a dip. It's moments like these that really highlight how sensitive markets can be to global politics, especially when a conflict with such far-reaching consequences is involved. But here's where it gets interesting. Markets bounced back almost as quickly as they fell. Investors seemed to conclude that while the exchange was heated, it wouldn't derail the ongoing negotiations. But it really does serve as a reminder of how political events can send ripples throughout the entire financial world. And adding fuel to the fire, oil prices decided to join the party by taking a tumble. Now you might be thinking, lower oil prices, that's good news, right? And you'd be right, cheaper gas is great for consumers. However, it also means less profit for oil companies, which could lead to cutbacks on exploration and potentially even create supply issues down the line. Considering delicate balancing act and the uncertainty surrounding the Trump-Zelensky meeting, coupled with ongoing trade tensions and Iraq's decision to resume oil exports from the Kurdistan region, just added layers of complexity to the situation. Now, meanwhile, in the United States, economic data was painting kind of a mixed picture. The personal consumption expenditures, or PCE price index, is a key measure of inflation, and the news was surprisingly good. Both the headline and core PCE measures showed that inflation was cooling slightly, and this suggests that the Federal Reserve's efforts to combat rising prices might finally be gaining some traction. But wait, there's a twist. Consumer spending also slowed down, and this raises some concerns about the overall health of the U.S. economy. So now the Federal Reserve is facing a tough choice. Do they prioritize keeping inflation in check or focus on supporting economic growth? It's a classic dilemma for central banks, this high-stakes balancing act with significant implications for markets and consumers alike. And if things weren't already exciting enough, the threat of increased tariffs decided to make an appearance. President Trump's announcements regarding potential tariffs on goods from Canada, Mexico, China, and even the European Union just injected a fresh dose of uncertainty into the markets. These tariffs, which are intended to protect domestic industries, create a ripple effect across the global economy. So picture this. You're a business owner and you rely on imported parts. Suddenly, those parts become 25% more expensive because of tariffs. It's a tough situation, and it leaves businesses and investors grappling with the potential impact on trade, supply chains, and ultimately economic growth. So how do the markets navigate this roller coaster of a day? Well, U.S. stock indexes actually managed to close higher despite that initial volatility. The S&P 500, the Nasdaq, and the Dow Jones Industrial Average all ended the day in the green. It seems like investors, after that brief moment of panic, chose to focus on the positive news like that cooling inflation data. European shares ended flat for the day, but still managed to post weekly gains, demonstrating a little resilience in the face of all this global uncertainty. Asian markets, however, experienced more significant declines, perhaps reflecting their greater sensitivity to trade tensions and global economic headwinds. And in the world of cryptocurrencies, prices took a tumble as the initial excitement surrounding the Trump-Zelensky meeting fizzled out. Now, this is where things get really interesting. Despite all that political drama surrounding Ukraine, Ukrainian bonds actually held relatively steady. That means that investors, at least for now, remain confident in Ukraine's long-term prospects, even amidst the conflict and uncertainty. It's a reminder that even in the midst of all the turmoil, there are still opportunities for those who are willing to take calculated risks. So what does all of this mean for you? Is this wild market swing just a temporary blip, or is it a sign of bigger changes coming up on the horizon? Well, the truth is, no one can predict the future with absolute certainty. But by staying informed about global events and their potential impact on the markets, you can make more informed decisions about your own investments. Make sure to stay tuned for part 2, where we'll dive even deeper into the details of this market roller coaster. And don't forget to like this video and subscribe to our channel for more deep dives into all the forces that are shaping our world. Heavy trading volume on U.S. exchanges really underscored the market's heightened activity. We saw a staggering 17.5 billion shares changing hands, compared to the average of about 15.4 billion over the preceding weeks. That surge in volume really speaks volumes about just how intense investor reactions were to the day's news. It's like this giant wave of buying and selling that's sweeping through the market, reflecting all the anxieties and hopes of investors across the globe. Now let's shift gears and talk about U.S. Treasury yields for a moment. They actually dipped to new multi-month lows following the release of that PCE report. Now, Treasury yields essentially represent the return that you get for lending money to the U.S. government. And when they go down, it basically means that investors are getting less bang for their buck. But here's why this is significant. This drop in yield suggests that investors are really seeking the relative safety of government bonds against all the uncertainty. It's this classic flight to safety where investors are looking to protect their capital during these really turbulent times. Or they're essentially saying, we're willing to accept lower returns in exchange for a safe haven. And then we have the dollar dollar index, which measures the strength of the US dollar against a basket of other major currencies. It actually rose, reflecting the greenback's safe haven appeal during times of global uncertainty. But on the other hand, the euro actually weakened against the dollar, falling to a 2-week low. Now, this currency movement just highlights how interconnected global markets really are. Events in one region can have a ripple effect across the entire financial landscape, impacting the value of currencies worldwide. Emerging market stocks also took a hit, reflecting investor concerns about the potential impact of escalating trade tensions and a stronger dollar on these economies. Now, emerging markets are often more vulnerable to global economic headwinds, and they tend to underperform when this risk aversion grips the market. It's almost like this domino effect, where negative sentiment in one part of the world can trigger a chain reaction across other markets. And meanwhile, gold, which is another traditional safe haven asset, actually experienced a decline. This drop might seem counterintuitive at first, but it can likely be attributed to the rising dollar, which makes gold more expensive for holders of other currencies. So it's just a reminder that even these safe haven assets can be influenced by a really complex interplay of different market forces. And now all eyes are on the Federal Reserve. With inflation showing signs of cooling but consumer spending slowing down, the central bank is facing a very delicate balancing act. Will they choose to prioritize taming inflation or supporting economic growth? The Fed's next move will be watched very closely by market participants around the world, because it has the potential to significantly impact interest rates, currency values, and even investment flows. Think of it as this giant chess game where every single move has far-reaching consequences. You know, that threat of these escalating tariffs that President Trump introduced, they've really added another layer of complexity to this already volatile market landscape. Yeah, the prospect of a 25% tariff on goods from Canada and Mexico going into effect sooner than we thought has definitely made businesses and investors a little nervous. Imagine like a local business owner who relies on imported parts from Mexico to actually make their products, and then suddenly their costs just go up by 25%. I mean, it's a huge hit to their bottom line, and it can even force them to raise prices or even cut jobs. Then on top of that, we have the additional 10% duty on goods from China and the possibility of a 25% tariff on shipments from the European Union, which just makes those concerns about a global trade war even worse. These protectionist measures, they're intended to protect domestic industries, but they also come with the risk of disrupting those global supply chains and raising prices for consumers and ultimately hindering economic growth. It's kind of like a delicate house of cards where, one wrong move could just send the whole thing tumbling down. But amidst all of this market turbulence, the performance of Ukrainian bonds really stands out. It's almost like a testament to investor resilience and maybe even a glimmer of optimism. Despite that pretty dramatic showdown between President Trump and President Zelensky, Ukrainian bonds actually held relatively steady. The 2034 maturity only experienced a minor dip, and this resilience really suggests that investors still have some confidence in Ukraine's long-term economic prospects, even with the ongoing conflict and political uncertainty. It's a good reminder that even amidst all the turmoil, there are still opportunities for investment and growth that can emerge. So as we kind of step back and look at all the whirlwind of market activity that happened today, a really important question remains. Is this volatility that we saw just a temporary thing, like a quick reaction to all these events happening at once? Or could it signal a deeper, more fundamental shift in market sentiment? Will this be what sparks a larger market correction? I mean, the answer, as always, is kind of uncertain. But by staying informed about global events and economic trends and those big policy decisions, you can better position yourself to navigate, the complexities of the financial market. And remember, knowledge is power, especially when things are this volatile. And that wraps up our deep dive into today's market roller coaster. We really hope this was insightful and helpful for you. If you enjoyed it, don't forget to give this video a thumbs up and subscribe to our channel for more deep dives into the forces that are shaping our world. We'll be back with more insightful analysis and perspectives to help you all make sense of this ever-changing market landscape. Thanks for tuning in.